Yes. Yeah. Good afternoon, all. Again, this is Dr. Mallikarjun, Associate Professor of Commerce, Government City College. Today we are going to discuss. Today we are going to discuss this block three under management and management control system. So in under black block three, there are two units are there. One is investment center. The second one is transfer pricing control. Okay, in previous class, yesterday we were discussed three topics. One is uh, profit center, cost center, and uh, responsibility center. So, it continuation of the previous block. Today we will discuss in depth in the two areas. One is investment center. The second one is transfer pricing and control mechanism. Okay. So let's start with the investment center. What is investment center? So in this unit, we are going to discuss what is the meaning of investment center, what is the futures of investment center, and different types of evaluation of performance of investment centers. Right? How to evaluate? What are the methods are there to evaluate investment center? Right. So here. In the previous session, we were discussed, like I already told you, a few topics like expenses center, nothing but a cost center, revenue center, profit center, responsible center. So today, what is the meaning of, let's see the meaning of investment center. The meaning of investment center is, according to CIMA London, the investment center is a profit center where the performance is measured by its return on capital employed. The very important one is return on capital employed. So, what is the return earned by this capital? Right? What is the return earned by this capital? Whatever this firm invested in long-term purpose, how much amount they are going to receive in terms of return. So that is a definition given in a CIMA London. Thus, a response center is an investment where is the manager is responsible for the sales revenue. If he's the manager of sales department, he will see the sales revenue and cost in addition to responsible for some capital investment decisions related to working capital management, capital structure theories, capitalization, cost of capital, like various other also responsible this manager. So his performance, the manager performance is measured in terms of the profit related to the capital base, right? So investment centers also like it as independent business where the investment decisions are made and managed by its divisions, like right. So what industry may be developed by a company where the investment center, if the manager is responsible for investment of total project, how much amount is going to uh, get the return of investment. So what are the futures of investment center? The features investment center is a business unit. Yeah. Excuse me. The investment center is a business unit that a firm utilizes its own capital to generate returns to that benefit. So every firm has to invest their amount. They want to get some returns. The functional arm of an automobile market maker, a department store, for example, complete of this investment center. Like in investment center, various activities happening in this department. Right. So investment center are increasingly important. The firm as a financialization leads to companies to seek more profits from investment lead to activities in addition to core production. You see the, for example, the metro Hyderabad Metro. So they have a different kind of activities in their metro project, like the advertisement part, like parking parts, and see that the passenger, and see that advertisement with the vehicles, advertisement in the metro trains, or these hoardings in these metro pillars, like the various activities are there. So how much return they're going to get in each activity. So the investment center are different for this advertisement purpose, passenger tickets, and see the advertisement within the train, or they see that right parking revenues, like they are seeing different investment center. You take an example of these metro projects, Hyderabad Metro. So, like in a company, also see that the company they are selling different kind of products and different kind of providing services also. See, like we take one more example of see that movie theaters. So the movie theater will get revenue from the parking place and also see this whatever the snack they will sell in this in between the movie. They also return and see that they're providing ticket price. Like so, like various investment centers within the organizations of the firm. So investment centers can utilize the capital in order to purchase other assets. So to see that purchase assets that the company are employing its capital to want to earn the returns. So investment center performance can be evaluated using these models, methods, nothing but the very important one is return on investment. How much amount the firm is invested, how much amount they're getting in the form of return. The second one is residual income. So that we are going to discuss what is residual income, how it is different from this return on investment, and see that economic value added. Like three measures are there to evaluate this investment center. That manager can conclude that the investment center is in a managing its capital or its assets properly. Right. So types of evaluation, as I told you earlier, one very popular one is return on investments. So see that the firm has invested, right? You see that the firm has invested this, like we take an example of a division. For example, a division of make a profit of 20,000, division B make a profit 10,000. Naturally, if you compare only profit, division A, division B, we'll conclude that division A is performed better than better than the division B. But if we compare with capital, right? If we compare with capital, we know that which division is giving the better profits, which division is performing well, right? So, like we want to compare with return to investments. So that is called as a return on investment. So ROI is calculated divisional profit divided by divisional investment into 100. See that the profit, right? Profits into profit by sales, sales into by sales by capital employed, sales will deduct, and the answer is uh, like right. So the sales final. So the answer is profit by capital employed. Like this boy example saying, we assume that uh, division A required a capital of 1 lakh, division B required a capital of 40,000. Now division A return on investment is 20,000 rupees of profit, like here the profit mentioned, and the capital is 1 lakh rupees. The division A return on investment is 20,000 and division B return on investment is 25,000. Right? So earlier what we conclude, division A is better than division B when we see the only profits. Once we see the ROI, return on investment, B is better than A. Right? So ROI has revised the concludes that it is proved that the performance of division B is better than performance A as its ROI is 25% as compared to 20% of A. Okay. What it like, any firm, any these firm, irrespective of is it small cap, mid cap, large cap, all firms are comparing their returns and using this performance, using this return on investment. If you introduce a new product in the market, it requires a huge capital and see that the profit, how much amount how much amount the firm can going to get. What are the advantages of this ROI, return on investment? Right? So ROI, there's various advantages the manager to take a various kind of decision-making process. It helps the manager to encourage the manager to pay careful attention the relationship between among sales, expenses, and investments. As should be easy of manager of an investment center to measure its performance. It encourages cost efficiency. If the manager is focusing on the cost control, naturally the profit may increase, ROI is also increase. it disagrees excess investment in operating asset. So the management, investment center will give this correct uh, uh, proportional amount to invest this each in asset. So ROI is the most important measure because it reflects overall performance with which capital is used. So this measure is helpful for taking a various kind of long-term as well as short-term investment decision-making process. It helps the manager very effectively. And also at the same time, there are some disadvantages of ROI, return on investment measure, in evaluating the investment center. Let us see this. What are the disadvantages? So this encourages manager for investing the project that would decrease the divisional ROI but increase the profitability of the company as a whole. So see that we'll see the as example is Hyderabad Metro. Example Hyderabad Metro. So if the passenger ticket amount is not that much, but this metro can get the more amount advertisement as well as this parking place is also we won't consider. But on the whole, we'll see that this either metro is profitable if you consider all 360-degree product. Right? Generally, the project with less ROI division currently ROI will be rejected. So we can't conclude that if one center investment that is not performance, we can't apply all these projects may not be rejected. Right? It encourages myopic behavior that the manager may focus on short term at the expense of the long term. Right? So we can't, based on that, we can't say that this ROI is not better. Right? So sometimes the ROI is also lesser, but long term that gives more results. So satisfaction definition of profit and capital employed may not be available. The profit may concepts such as profit before tax, after tax, profit before interest and taxes, like various kind of similar capital employed may be taken as a gross capital employed, net capital employed, assets include or excluding of intangible asset like goodwill, patent, copyrights, trademarks. Assets can be at the book value or the market value, like the various uh, assumptions are there to calculating this ROI. So ROIs of a different firm make an analysis, their own comparable performance may not be served. The purpose of follow different accounting policies and methods in respect of the valuation of fixed asset, valuation of stocks. See that valuation of fixed assets also the firms can follow various kind of accounting policies. Either they can go for fixed installment method or return on value method, or the evaluation of stock. The firm can go for LIFO method, weight method, average method. Like there are various kind of method they can method to see the allocation of this department-wise allocation of cost. Also, the firm can follow different kind of methods. ROI may not be suitable for making the analysis for short-term performance. So it can measure with the long-term performance for short-term performance. So initial years, as investment is give a very small ROI, which may mislead the management and wrong decision making in making for long. We can see these bigger firms. Tata's. We take an example of Tata's Judio, right? It's a cloth showroom run by the Tatas. Initially, it will take 10 years time to get better ROA. So, right, it will take a lot of time, some time. So, bigger company only will survive, right? Otherwise, a small entrepreneur may not wait for this return. Initial stage, the firm has to sell the product at a cheaper rate. It will take a lot of time to build a brand and attract the customers, appoint a good brand ambassador, and identify good locations and appoint a good employee, sales management to see that either the company has to take decision either sell their product is offline or online, right? The packing style, logos, like various factors are influencing to get is better ROI. It's not just we can't judge based on the ROI the firm performance, investment center, right? In short-term purpose. So let us come with second one, economic value added or residual income method for evaluation of investor center performance, right? So overcome the tendency of using ROI. There's some limitations ROI to down investments that profitable for company can more division ROI. See the residual income nothing but divisional profit by divisional investment into rate of interest. So whatever the capital the firm is procured, it's not the free of cost. The firm has to procure some from some various sources. Like the firm can issue the equity share, the firm can issue the preference shares, or bonds or debenture, or take a bank loan, right? Long-term loan. So some cost is there. So that cost is also called as cost of capital, the weighted average cost of capital, or average cost of capital. Right? So budgeted residual income is divided. See that the firm income is 10 lakhs rupees. So interest charge. So the firm is the investment is 60 lakhs rupees procured at rate of 12%, 70 lakh 20,000 rupees, and economic value added is 2 lakhs 80,000. After payment of this cost of capital, right? But interest charges, whatever the amount is available, is at 2 lakhs 80,000 rupees. Will compare with investments. So earlier, before in ROI, we are not considered this. Just we compare income by this, right? 10 lakhs by 60 lakhs. We say that 60% the profit is earned. ROI is 60%, but not now. So in this method, what we compare is 2 lakh 80,000, right? 2 lakh 80,000 divided by 60 lakhs, like into 100, like we calculated this ROI. But as per this return of investment value, will compare. So interest rates may be applied for different kind of component investments like assets, inventories, various sources. What are the advantages of this residual income approach or economic value added approach? So residual income approach method has an advantage showing the divisible ability to earn more than the cost of capital. The firm has to earn on its investment at least equal to cost of capital, or any additional investment in a division will acceptable if it is increase the residual income. So divisional manager are made to realize that there is an opportunity cost of funds used by the division in the most format of cost of capital. The firm has to earn. So goal encourages more likely to achieve by the residual income rather than return on investment ROI. There are serious disadvantages also this residual income approach. It may be difficult to determine the rate of interest for calculating this cost of capital. But it's maybe easy if the manager knows these sources of funds and what is the difficult part is how to calculate return on equity capital. Return on equity, sorry, cost of equity capital. How to calculate this exact cost of equity capital. Most of the operational difficulties is measuring divisional profit and investment faced in ROI method are also present in calculating this residual incomes. Like, right? And residual income is an absolute measure of performance because it is expressed in rupees. Earlier one we express in terms of percentages, now we express in terms of rupees. It will not provide a proper base for evaluating of organizational performance, which is affected by the size of its organization. The size of organization may be small cap, mid cap, and large cap firms, right? And third method is economic value added approach or Steward approach. So during this 1990s, so residual income has been redefined and renamed as economic value added method. So this method has registered, it's a their trademark, right? So EVA concept extended to traditional residual income measure by incorporating adjustment divisional performance measuring against destroys introducing general accepted accounting principles. So, like here, EAB, conventional divisional profits, whatever the earlier profits, and will add accumulated adjustments. Adjustment minus average cost of capital charges on whatever the division assets. So, like adjustments may be chosen as conventional divisional profit of measures to replace historical accounting data, whatever the data is available in the firm based on that. He suggested steroid stiffest supported 160 accounting adjustments, but most of the probably will use only 10 adjustments. So these 10 adjustments adopted by this economic value added approach, reducing some harmful side effects arising in using of financial performance. So, like return on investment, he will be more likely goal encourage this type of investment. So, like he suggested, economic value approach is especially this surplus left after making appropriate charge of a capital employed of the business. So EAV is equal to how we will calculate net profit after tax, net profit, net operating profit after tax minus cost of capital of X, cost of capital into economic book value of capital employed in the firm, economic capital employed of the firm. Or else we'll calculate economic book value of the capital employed in the firm, nothing but return on capital minus cost of capital. Whatever the return on capital, cost of capital, we calculated. Or else we calculate profit after tax plus interest 1 minus marginal rate of marginal tax rate of the firm minus cost of capital. Like the various formulas are to calculate this EAD method, economic value added approach. Like we'll take an example. So like Maruti Limited and balance sheet and profit loss when given like this, the firm capital, equity capital is 1 lakh and debt is 1 lakh. The total long-term capital is 2 lakhs rupees. At the same time, the fixed assets are 1 lakh 40 and net current asset is 60,000. It is 2 lakhs, 2 lakhs. And you will see this income statement of this Maruti Limited, net sale, the firm net sales during the year is 3 lakhs rupees. The cost of goods sold 2 lakh 58,000 rupees. So 3 lakhs minus 2 lakh 58,000 rupees. The firm EBAT nothing but operating profit, earnings before interest and taxes. So this EBAT is also called as earnings, earnings, earnings before before interest and taxes. Interest and taxes. So EB8 nothing but it's operating profit 3 lakhs minus 2 lakh 58,000. It is 2 lakh, it is 42,000 rupees. Then the interest on debt capital is at 12,000 rupees. Is 12%. We assume that the 12% capital interest on debt 12%, 42,000 minus 12,000. So EB80 earnings before tax is 30,000. The tax 30%. If you assume the tax is 30%, 30% on this 30,000, 9,000. Earnings after tax is 21,000 rupees, earnings of 10,000. So the additional information is given, like the cost of debt interest is 18%, cost of equity is 18%, capital 18%, the tax rate is 30%. So let us calculate profits on debt capital like not 12%, and the amount is tax exemption. Whatever this amount paid to these debenture holders are tax exemption. So that is the reason 12% into 1 minus 0.3, 8.4% of cost of debt. So like see that here weighted average cost of capital, uh, weight of X of X into profit of Y. See the weighted average cost of capital 50% proportion, right? So 18% into 15%, 8.4 is the cost of debt into the total is 13.2% is weighted average cost of capital. The firm at least earn in its capital, in its return, at least 13.2%. But net operating profit after tax, EBIT into 1 minus T, See that 29,400 rupees. So the return on capital employed. So whatever the 29,400 and the capital employed will take only equity capital uh, into 14.7%. So it is higher than return on capital employed 14.70, but weighted capital is 13.20. So the firm return is higher than this cost. The return is higher than the cost, right? So cost is 13.2%. 13.2% is the cost of capital, but ROE is higher than this 14.7%. 14.7%, right? So here, uh, calculate all these, all these, right? So here is calculated like this, profits. Net profit after tax is 29,000 minus 13.2% of uh, cost of capital into 200, like two proportionate minus it is 3 lakhs rupees in terms of EAV, economic value added asset. So like here we can see that uh, the firm is how the firm is measuring the performance, right? See that there are three other components are in EAV model, economic value approach model. Note nothing but net profits after tax, net profit after tax, net profit after tax, no PAT, no PAT. So net profit after tax nothing but profit before tax minus into 1 minus tax rates. So this definition is based on the two principles. They are separate investment in financing asset of the company. If it implies that financing charges like interest and dividends are not considered when we look at the profit and all these, right? So second one is cost of capital is also called as there are various we call as the cost of capital like uh, we call cost of capital also called as standard rate, target rate, cutoff rate, hurdle rate. So it's a benchmark. Also, it's called capitalization rate. The firm has to earn at least this amount on its investments, right? It gives it's a cutoff rate. It provides of capital that is nothing that is shareholders or lenders. They need to earn at least they need to earn they need to earn this suitable compared investment of capital uh, company. It represents the average cost of all the source of capital. The source of capital, nothing but equity capital, preferred shares, debentures, including retained earnings. It is calculated in post-tax returns, post-tax terms. So whatever the tax amount, whatever this tax paid to the debt holders is exemption. It reduces the risk borne by these various providers of capital. So capital employed is also to obtain the capital employed in business, whatever the amount is employed capital. So the firm is 1 lakh rupees in their capital. This total amount are employed means they have to utilize the amount. For example, the company mobilized is 10 lakh rupees. The company mobilized 10 lakh rupees, right? But they use only 5 lakh rupees for this business purpose. Remaining 5 lakh rupees, they are ideally deposit bank. It's not used, right? So capital employed is not, whatever the amount is uh, mobilized through the capital, the total amount will be employed, right? Utilized to getting this return. So how the firm can improve this EV economic value added? So operating profit can be made to grow without employing more capital. Operating profit may be increased more without no additional capital is required. The firm has to get good profit without adding any additional capital. The second one is additional capital is invested in project that the return more than the cost of new capital, right? So if the company want to require additional capital, they can mobilize the capital at lower rate, not this higher rate. The capital is curtailed that does not cover this cost of capital. So growth is maintained by this retained profit. So long as its return will be exceeded the weighted average cost of capital. So better financing policy is adopted with reducing the cost of every firm has to reducing its cost of capital. Why? Because if the cost of capital lesser, the firm get good profit. It goes to the maximizing the wealth of the shareholders. So ultimately, the object of the management, they need to maximizing the wealth of the shareholders. They are the real owners, right? And whatever they take a good decision, it reflects this increase the market value of the shares, right? So this Stewart's adjustments are the 160 they proposed, but the 10 are more relevant, more popular. That nothing but research and developments. Right? Every firm has to spend amount for research and development purpose, especially pharma company, pharmas, not pharma company. For example, the in pharma company, like we'll take an example, Reddy's Pharma's company, Reddy's Pharma, Reddy's Laboratories, they develop a medicine. Initially, they're getting a lesser return ROI, but in longer period, the firm get higher period, right? We can't say that initial period the good profit. After a certain period, the firm, it's a drug is very popular. It's helps to these more health. Then the people can also get this more advantage. The firm will also get better profits like strategic investments. So, like EVU, economic value approach under strategic investment decisions of a firm, the firm has to, every firm has to expand its operations, they enter a new business model and acquiring these competitors, right? And they want to increase the market share. If they want to develop a brand and they want to penetrate the market, like various kind of investment strategies are required. It may be long-term purpose, not the short-term purposes. Right? Right. The firm has to recognize expenses. If the firm identify the expenses, they will control. They can recognizing these. Once you recognize they can identify the possibility of reducing this cost. Enter a new market, as I told you earlier. Enter a new market, expand the capital base, and gain market share. A firm has to increase the market share. Right? They want to be market leader uh, under GAAP, general accepted accounting principle, they are non-treated as a current expenses through they are expected to generate benefit for a longer time of period, right? So depreciation is also one of these very important concept to take a various kind of investment decision making process. So it's restructuring the charges. The firm has to restructure their right? The change treated as a lesser for the investment that has turned very bad, like right? Like taxes also playing a very important role. The company may accelerate with the depreciation is also shown the tax exemption and market securities. If the firm perform well, the firm has to get good profit. Automatically, the market price of the share is also may increase. Like various uh, parameters are there. So there are various advantages of this economic value approach. It is a tool to help the manager to focus on attention on the impact of their decision, increasing the share value of the equity shareholders. Right. So whatever the decision taken by the management, they see that either decisions are three, like investment decision, like right, investment decision, financial decision, dividend decision, the firm has to, right, the management has to take right decision, right time. The firm will get increasing this value of this uh, shareholders. So economic value add approach also good guide investors on the basis of they can decide whether particular company is worthy invest or not. So this gives a direction to the investor also. So if any investor can buy this company stock, the amount is safe or secured, it provides a good return or not. Like it gives some earnings. So EVA can also use it for basis of valuation of goodwill and shares. It gives a direction to how to calculating the goodwill of the firm and share value, the intrinsic value, how to will calculate intrinsic value. Nothing but if you compare that intrinsic value to present market value, the share is overvalued, undervalued, or fair valued. Then the investor can take this share, or they can hold, or they can buy, they can exit, or they can buy the company stocks, right? So EB is also good controlling device to decentralize of enterprise. Every firm has to decentralize it. They need to increase market share. The management can also apply to find out EVA contribution each decentralized or segment wise of the company. So EV is linked compensation scheme, both operative and management also, right? So, so like there are various kind of advantages of EVA method for measuring this investment centers. Like there are serious limitations also in this EVA approach. Like EVA analysis does not necessarily eliminate the problem of comparing performance and large and small divisions. Right? Every division its own size of the transaction, size of the capital, and customer perception, customer behavior, income style of the customers. Like we can't compare one to another. Like it's every store is unique, right? So most of this problem of measuring the divisional income and division investment base also, there is the additional risk for selecting a fair and equitable measure of this requirement of cutoff percentage, right? Like there are some limitations. The fourth one is multiple performance measures. So whatever earlier we talked about three, like ROI method, residual income method, economic value method, all are three important measures to measure this mm, financial measurement, not the overall 360-degree measuring the firm's performance. Just we compare financially these profit center versus these investment center is good or bad. Like, right? They have to earn the profits is better or not. But the multiple performance measure, right? It gives some don't see the profits right now. So you can see this company growth as a whole for the long-term prospect. Some non-profits is also very most important. Like see that the goals of multiple structure of a GE electronic company, General Electric company, the profit will see also one, then market position of the company and the productivity of the company, product leadership of the company, like personal development, employees' attitude, public relationship, balance between long-term as well as short-range goals. Like these is also very most important to measuring these investments and the performance. Right? The profit is not only criteria to measure the performance, like various factors also uh, playing a very important role to measure the investment center performance, right? Like now, this is one example. We'll see that ABC Limited has three divisions, A, B, C, and the operating result of three divisions are as follows. So the sales are A division is 50 lakh, B division 50 lakh, C division is 1 crore. Because naturally, if you see the sales, uh, division C's performance better than A and B. Why? Because the sales are 1 crores. Remaining two division sales are 50 lakhs, 50 lakhs. See the cost. So the cost is 40 lakhs rupees of A division, 30 lakhs B division, and 60 lakhs C division. So see here, after sales minus cost, division A is profit is 10 lakhs, B is 20 lakhs, and C is 40 lakhs rupees. Right? Now we'll see the compare with profit. This capital, Investment of division A required 30 lakhs rupees, division B is 50 lakhs, division C is 1.5 crores, right? So we require to calculate ROI at these divisions and rank that they're based on this performance. So naturally what we can do is we can follow this ROI method, return on investment. So these 10 lakhs rupees divided by 30 lakhs rupees, right? 10 lakhs rupees divided by 30 lakhs rupees. Like division here, 10 lakhs rupees profit by operating profit by this investment into 133.33%. And division D is 20 lakhs rupees and profit investment is 50 lakhs rupees. It is 40% of return on investment. And here you can see that profit is 40 lakhs rupees. It is higher than compared to divisions. And 40 lakhs rupees, the investment is 1.5 crores. It is 26.67%. So if you see the only sales, division C is better than A and B. If you see the profits, if you see the profits, division C is better than A and B. But if you calculate this ROI, so division is better than division A and division C. Division C get third rank and these A and B got first and second rank. So what happened here? These division C sales are very high. At the same time, it required higher capital, higher investment amount, right? So like, okay, his performance, this division performance, right? Investment center. Like which investment center is better? The investment center B is better than A and C. So let us take one more example. Express India Limited has three divisions, right? Three divisions. Considering the additional investment of one of these division, it required more information, right? So division A is 15%, division X is a 15% ROI, division Y is 16%, division Z is 14%. So division Y is higher ROI. The cost of capital is 12%, which division more investment to make. So the firm has to add additional capital. So which one is better? All three divisions ROI is higher than this 12%, right? The cost of capital is 12%, and here more than 12%, it is 15%, 16%, 12%, 14%, right? Here the excess is 3% is excess. Here 4% excess. Here the 2% excess. Excess and this uh, cost of capital, right? Now we'll see the solution of this. Uh, it is 14%, 13%, and 7%. If the firm has to get additional capital for 12%, which one is getting here? 16%, 15%, and 14%. The investment should be made division check because ROI on additional is higher than at 17%. It is 17%. Uh, but against the current ROI is 14%. Division X is 14% and ROI is also 15%. Like right, the product division, thus the additional investment in division X and division Y should not be acceptable. Why? Because it gives only 14 to 13%, but here 17% gives additional capital. Like you can prepare examination point of view, one or two problems, the examiner may ask you to calculate ROE, the various factors, right? So after this, we have one more unit in the same block number three, right? Block number three, transfer pricing and control. Transfer pricing and control. It is unit number 7 in our syllabus. Uh, what is the meaning of transfer pricing? Objectives of transfer pricing, fundamental principles of transfer pricing, ideal situation of transfer pricing. What are the methods of transfer pricing? Problems with transfer pricing, technical issues of transfer pricing, additional administrative, like all these are there. So, what is the meaning of transfer price? A transfer price arises for accounting purpose with different divisions of a multiple entity company over, oversee this own, they want to see that own profits. So when the divisions are required to transact with each other, the transfer pricing is also determined the cost, right? So like what are the objectives of transfer pricing? The first and foremost objective is to evaluate the current performance and the profitability of each individual unit. Like yesterday also we talked about Starbucks. In Hyderabad, there are 10 Starbucks outlets are there. Now the firm has to evaluate the profitability of each store, what is the profit of this Starbucks store, right? And also it used that to improve the profit position. The transfer pricing will help to make a unit competitive so that they will maximize its profit and contribute to this overall profit of the company to assist a decision-making process. The transfer pricing is help to this taking various kind of decision-making process. Decision makers like make or buy a product or sell or further process. Like sugar company can produce, they can sell the sugar or they go for other process also choice between two alternative products. They can, if the textile company, they can focus on this men wear or women wear or kid clothing. So which kind of they need to select? It gives assess, right? For accurate estimation of earnings on proposed investment decisions. So they estimate these earnings of various investment decisions to allocate profits of a multinational business organization. Also, it helps goal courage is also it helps these transfer prices. So, what are the fundamental principles of transfer pricing? So, the fundamental principle the firm should produce the product inside the company or purchase it or outside the vendor. So, they need to take a decision, right? And if product inside, what price should the product transfer between the profit center, right? Right, but it's not easy to get this fixing the price of any commodity in a perfect market, competitive market, right? So, competent people, ideally, the managers should be interested in long-term as well as short-term performance of their responsibility centers, right? So, like good atmosphere is required. The firm has to increase the market price, right? They want to be market leader. They to be price makers, not price. They want to price maker, freedom to source, like various situations to for ideal transfer pricing. Full information, manager must know about these availability of alternatives and relevant cost and revenues of each, right? Negotiation also there. So like various methods are there for transfer pricing, like market-based pricing, cost-based pricing, real pricing, and negotiable pricing is also there. Let us discuss one by one. First, we'll focus on market-based pricing, market-based transfer price. So market-based pricing prefer uh, right? So where when there is a competitive external market, there is a transfer product. The market prices will work will as a transfer prices. When the transfer goods are recorded at a market price, divisional performance more likely to be represent their real income contribution. So unbiased and less ambiguous competitive pricing is also there. The advantages of market-based pricing. Disadvantages, appropriate market price may not be exit. Excess production capacity is also there. So like cost base is very easy to cost based pricing, cost based transfer price is very easy. And the advantage is a benchmark. What is the cost? Then added some profits. Like cost based transfer pricing, we consider this what is the variable cost, what is the standard cost, and full cost, and uh, full full cost plus plus makeup. markup loss, right? So there's some disadvantages. So subjectivity and a little incentive is also there. The variable cost and is also there. Now we move on to third one, full cost based transfer model, and it's also some advantages and limitations. Third one is dual transfer price. So it's also recognized two-way prices. It's also known as two-way pricing, two-way prices. Under this method, the selling division is credited with one price. That may be cost plus profit margin, whereas the buying division is charged at the decimal prices. Right? There are some method to so negotiating prices also there. So negotiate the pricing. Right? So there are some example given here. Go through it. Right? Like few problems are there. Better to go through it. Next, after this block. Now, next class, we are going to discuss block 4. Under block 4, there are four topics are there. One is programming and budgeting, and next one is ninth one, variance analysis and reporting. 10th unit is performance evaluation, and 11th unit is management art, how the management will time and this audit. So now I will stop here. Next class, we are going to discuss for the programming budgeting. Like what are the essentials of the budget and budgeting, the how to form a budget, what are the behavioral aspects to form a budgets, what are the qualitative techniques, and what are the different types of budgets like zero-based budget and now master budget. And these budgets are also helps the management to control its operations and see that they will compare budgeted figures to actual figure and they will evaluate the firm performance. So like it use one of these control method, right? There's a control method to uh, measuring the performance. Okay. So essential of a budget, that part we'll discuss. Okay. So I will stop here.